The Psychology of Investing. Chapter 16. The Psychology of Portfolio Diversification. Diversification is one of the most useful tools in investing because it protects you from the damage of any single mistake. But there is an important psychological trap here. Once people learn that spreading risk is good, they often assume that more holdings must always be better. That is not always true. After a certain point, adding positions can create the feeling of safety without adding much real protection. A portfolio becomes safer because its holdings are meaningfully different, not simply because the list is longer. So the key question is not how many things you own, but whether each holding adds something distinct. Over-diversification often feels safe because a long list looks impressive, careful, and sophisticated. When investors see many fund names or many stock positions, they naturally assume risk must be widely spread. But names can be misleading. Several different funds may all own the same large companies underneath, so what looks broad may actually be repetitive. That overlap hides concentration, especially in popular parts of the market. In a broad market decline, those holdings can still fall together, even though the portfolio looked well protected on paper. This is where overlap becomes especially deceptive. You might own a US large-cap fund, an S&P 500 fund, a total US stock market fund, and a growth or technology fund, and feel nicely spread out. But those holdings often lean heavily on many of the same large American companies. On paper, you have 4 funds. In reality, you may have one big bet on the same section of the market. Different labels do not guarantee different exposure. A portfolio can look varied while still being concentrated in large US stocks, especially tech-heavy names. Too many holdings can also create hidden costs. Fees that seem small in isolation can add up across many funds, and trading costs can quietly chip away at returns over time. Complexity is another cost, even if it does not show up on a statement. When a portfolio becomes crowded, it gets harder to monitor what you own, harder to spot overlap, and harder to notice when something no longer belongs. Important details get buried in the noise. So over-diversification does not just risk redundancy, it can make the whole portfolio less efficient. The biggest benefit from diversification usually comes early. Moving from a very concentrated portfolio to a reasonably broad one can reduce risk in a meaningful way. But after that, each extra holding often adds less and less because it may simply repeat exposure you already have. This is the point of diminishing returns. The curve of risk reduction flattens, while fees, clutter, and maintenance may continue rising. That is why a broad, sensible portfolio often captures most of the benefit without needing endless additions. It also helps to be clear about what diversification can and cannot do. Diversification can reduce company-specific risk, so one bad earnings report or one failed business does not sink your whole portfolio, but it cannot remove market-wide risk. If stocks broadly fall, owning more versions of the same stock market will not protect you much. Some risk is simply part of investing. Real diversification comes from combining different sources of risk and return, so each holding contributes something meaningfully different, instead of repeating the same market exposure. A practical way to keep this under control is to make every holding earn its place. Start with a simple core of broad funds rather than a scattered collection of products. Before adding anything new, check how much it overlaps with what you already own. Then ask a very direct question. What role does this investment play? If 2 holdings do the same job, one of them may be unnecessary. A well-built portfolio is defined more by purpose than by size. Efficient portfolios are usually simpler than many investors expect. For a lot of people, 3 to 6 broad funds are enough to achieve meaningful diversification. And some investors can be fully diversified with only 1 or 2 very broad funds. The goal is not to own as many pieces as possible. The goal is to own enough distinct pieces to spread risk without creating unnecessary friction. Simplicity makes rebalancing easier, review easier, and discipline easier. And that is why occasional rebalancing tends to help more than constant tinkering. Priya's example shows how this works in real life. She believed that owning 15 mutual funds made her safer, but a closer look revealed that 8 of them held many of the same large US technology companies. So, despite the long list, she had more overlap than she realized. She was also paying an average annual fee of 1.2%, which is a heavy drag over time. After simplifying to a total stock fund and a bond fund, her diversification remained broad, but her annual cost dropped to 0.1%. Her portfolio became both clearer and cheaper. A good portfolio review is not just a count of how many things you own. It is a review for clutter. List every investment. Note what it holds, how much of your portfolio it represents, and what it costs. Then, look for funds or positions that are giving you nearly the same exposure in different packaging. If possible, keep the final lineup to a small number of purposeful holdings. The goal is not to force a magic number, but to remove duplication, so each position has a clear job. A different diversification problem appears when investors lean too heavily toward what feels familiar. Home bias pushes people toward companies in their own country, and familiarity attachment pulls them toward brands, industries, or names they know personally. That comfort can feel like safety. Recognizable companies seem easier to understand, and local markets seem easier to follow. But comfort is not the same as protection. A portfolio built mostly around the familiar can still be dangerously concentrated. Home bias becomes visible when your domestic holdings are much larger than your country's share of the global market would suggest. Investors often overweight their home market because local brands, language, and financial news feel easier to follow. That ease creates a sense of control. But easier to follow does not automatically mean better to own in oversized amounts. One useful clue is to compare your domestic allocation with global market weights. If your home market makes up a modest share of the world, but dominates your portfolio, familiarity may be shaping your decisions more than diversification is. Familiarity can also hide concentration in a subtler way. You might own a local bank, a domestic energy company, a retailer, and a home country index fund, and think that looks nicely varied. Yet all of them may still depend on the same economy, the same currency, the same interest rate environment, and the same political system. In that case, the portfolio has variety on the surface, but one shared foundation underneath. A local shock can hit many positions at once. So apparent diversity across industries may still be concentration at the country level. The brain misreads this risk because familiarity feels like predictability. If you use a company's products, hear about it often, or see it in local headlines, it can seem easier to judge. That feeling creates confidence, but confidence is not the same as evidence. Local companies are not automatically safer, and well-known brands are not automatically better investments. Investment quality still depends on things like valuation, resilience, profitability, and how the holding fits your overall portfolio. Familiarity may help you notice an idea, but it should not be mistaken for proof that the idea lowers risk. This risk becomes even more serious when your job and your portfolio depend on the same source. If you work for a company or in an industry, or in a country that already drives your income, then owning more of that same exposure adds concentration on top of concentration. Employer stock is a common example. A downturn could threaten your salary, your bonus, your job security, and your investments at the same time. That creates a double hit, or even a triple hit, if retirement benefits are tied in as well. Many investors overlook this because the familiar feels normal, but it can be one of the most important risks in the whole portfolio. Home bias often develops gradually rather than through one dramatic choice. An investor may begin with a few companies they recognize, then keep adding more familiar names over time. Later, they may buy a fund that tracks their home market and feel even more diversified. But much of that portfolio can still point back to the same country exposure. The overlap often stays hidden until a downturn reveals it. By then, what felt comfortably familiar turns out to have been one broad domestic bet all along. Maria's situation makes this easy to see. She appears diversified because she has several different-looking exposures. Her job at a Brazilian bank, employer stock through compensation, a Brazilian energy company, and a retail fund. But all of them depend heavily on Brazil's economy. So the real portfolio is not a collection of separate risks. It is one underlying economic bet, expressed in different ways. That is what hidden concentration looks like. Different wrappers, same dependency. If Brazil weakens, Maria's losses come from correlation, not from owning too few positions. Falling commodity prices could hurt the economy broadly. Her employer might cut jobs, and the stock could decline at the same time. Her energy holding and retail fund could fall as well, because they share the same economic pressure. So many positions go down together instead of offsetting one another. The problem is not a lack of quantity. The problem is too much exposure to one economy. The solution is not to eliminate all home exposure. It is to avoid making home exposure your entire strategy. One practical step is to compare your domestic allocation with your country's global market share. Another is to deliberately add companies, sectors, and countries that do not depend on the same local drivers. Broad international funds can make this much simpler. You can still keep some home country investments if they matter to you, but they should be one part of the portfolio. A quick self-check can reveal whether familiarity is shaping your allocation too strongly. List each holding and note the country or region behind it. Count how many positions are tied to your home country and estimate what percentage of the portfolio that represents. Then compare that number with your home country's share of the global market. If your portfolio is far more concentrated at home than the world market is, that is a strong clue that home bias may be present. Awareness alone can be enough to begin widening your exposure in a thoughtful way. Another path to poor diversification comes from the opposite emotional force, overconfidence. When people trust their judgment too much, a focused portfolio can feel smarter and safer than it really is. They may believe they have identified the best ideas and that spreading out would only dilute returns. But fewer holdings also mean less protection when they are wrong. Concentration can raise risk far more than many investors realize. So overconfidence often narrows a portfolio just when humility would improve it. This pattern often begins after success. A few good outcomes can feel like proof of special skill, especially if those wins happened quickly. An investor may start to believe they have found a repeatable formula. But strong short-term results can also come from timing, luck, or simply being in a market environment that favored that style. Over a short period, it is very hard to separate skill from circumstance. Markets do not reward skill alone, and they rarely move in only one direction forever. So early success can create false certainty if it is interpreted too confidently. Under-diversification usually builds little by little. A few investments do well, confidence rises, and the investor keeps shifting more money toward favorite ideas. The portfolio may still contain multiple holdings, but many of them begin sharing the same theme and the same drivers. For example, technology, growth, semiconductors, and innovation funds may look different while depending on similar market conditions. Over time, the original plan gives way to a dominant idea. What began as conviction quietly becomes concentration. Concentrated portfolios are fragile because one setback can damage several positions at once. A company-specific problem can hurt a large portion of the portfolio if that position is oversized. A sector decline can be just as harmful when several holdings depend on the same forces. Correlated investments often fall together, which means there may be very little else available to cushion the blow. Recovery can then become harder because the portfolio has fewer independent sources of return. Concentration may feel efficient during good times, but it often proves brittle during bad ones. Hindsight makes this worse. After events unfold, investors often feel that the outcome was obvious and that they saw it coming all along. That false sense of foresight makes past decisions seem more skillful and the future seem more predictable than it really is. A lucky win starts to look like an intelligent forecast. That feeling can increase confidence after the fact, even though the uncertainty was real at the time. The danger is that hindsight encourages even bigger concentrated bets in the future. Strong conviction does not remove uncertainty. Even a well-researched idea can be hurt by timing, valuation, policy changes, competition, or a shift in market sentiment. No theme leads forever, and no investor can know the future with certainty. That is why diversification is not a sign of weakness or lack of courage. It is a practical acknowledgement that good ideas can still go wrong. The healthiest mindset is to let conviction influence a portfolio without allowing it to dominate the whole portfolio. Sophia's example shows this clearly. She invested in 3 clean energy companies, and her portfolio grew from $10,000 to $18,000. Those gains strengthened her belief in the theme, so her conviction deepened. But all 3 holdings shared many of the same risks, including policy changes, rates, subsidies, and investor sentiment toward that sector. When the environment turned, the whole group was hurt together. Her portfolio later fell to $9,000, not because clean energy was inherently bad, but because her exposure was too concentrated in one theme. A broader allocation could have changed the outcome meaningfully. If only a quarter of Sophia's money had been in clean energy, with the rest spread across healthcare, consumer goods, and bonds, the sector decline would likely have affected only one part of the portfolio. The losses in clean energy might have been cushioned by holdings exposed to different drivers. Bonds, in particular, could have added stability. Diversification would not have prevented all losses, but it could have reduced the total damage. That is the real value of balance. One setback does not have to become the whole story. A quick portfolio review can help you spot whether confidence has replaced balance. Start by listing every investment you own and labeling each one by sector, theme, or asset type. Then, estimate how much of the portfolio each category represents. If one theme grows beyond about a quarter of the portfolio, that is a signal to look more carefully. It is not automatic proof that the allocation is wrong, but it is a cue to examine whether different positions are really carrying the same risk. The number of holdings matters less than the similarity of their exposures. Several mistakes tend to appear again and again when overconfidence narrows a portfolio. Investors may confuse familiarity with safety, treat a winning streak as proof of skill, or assume similar holdings are automatically diversified. Another common mistake is refusing to rebalance a favorite position because it feels special or proven. These patterns all have one thing in common: they encourage attachment to certainty. Good portfolio design works the other way. It is built around the possibility of being wrong, and that is exactly what makes it more resilient. So far, we have been talking about diversification in terms of what you own. But diversification also has a behavioral side. A portfolio can look well balanced across stocks, bonds, and other assets, yet still be vulnerable if the same emotion drives every decision. If fear, excitement, or impatience shows up everywhere, many holdings can end up behaving like one large emotional bet. In that sense, behavior can create hidden concentration. Asset mix matters, but decision patterns matter too. This becomes obvious when different investments are handled with the same emotional reaction. Fear can trigger broad selling across many holdings, even those that were meant to provide balance. Excitement can push an investor to chase trends in multiple parts of the portfolio at once. Urgency can make every decision feel like it has to happen immediately. On paper, the portfolio may still appear diversified. In practice, if the same mistake is repeated everywhere, those many holdings behave like one big position at exactly the wrong time. Behavior itself can become a concentration risk. One investor may oversize positions because of overconfidence. Another may panic and sell across all accounts when markets drop. Someone else may be so cautious that too much money stays uninvested for too long. These investors may hold very different portfolios, yet the real vulnerability comes from the same place: an unbalanced repeated response. When behavior consistently overrides design, it can matter more than the asset allocation itself. That is why self-awareness belongs inside portfolio management, not outside it. Behavioral diversification means building a counterweight to your default reaction. If you tend to act impulsively, the counterweight might be a required pause before placing a trade. If fear tends to freeze you, the answer might be small planned steps rather than all or nothing decisions. If trend chasing is your weakness, a checklist can slow you down and force evidence to lead emotion. If overconfidence is the issue, position size limits can stop one idea from taking over the portfolio. The goal is not to change your personality. It is to pair your personality with a balancing habit. The process can be simple. Start by reviewing your last 3 investment decisions and identifying the emotion behind each one. Was it fear, FOMO, impatience, pride, or something else? Once you notice the repeated pattern, choose one balancing behavior that directly addresses it. Then turn that behavior into a clear rule you can actually follow. Test it in small situations, review how it worked, and adjust if needed. The value comes from making self-knowledge practical, not just insightful. Good behavioral rules are concrete and realistic. Wait 7 days before new buys is useful because it is specific. Do not sell after a 1-day drop works because it interrupts panic without pretending that selling is never allowed. Invest a fixed amount each month can steady someone who otherwise reacts too much to headlines. Limit new positions to 5%, helps contain overconfidence. Strong rules are tied to your actual weakness, and they guide decisions without becoming so extreme that they stop being workable. Alex's portfolio shows why this matters. She owned 20 stocks, which sounds diversified, but she had a habit of selling quickly whenever a holding dropped about 10%. In a downturn, that rule of thumb turned many separate positions into one repeated emotional trade. The number of stocks did not protect her because the same anxiety shaped every action. Her counterweight was simple: delay and review. By waiting 2 weeks before selling, she created space for emotion to cool and for facts to matter more. This is something you can practice directly. Look at your last 3 investment decisions and write down the emotion behind each one. Then ask which feeling shows up most often. That repeated emotion is your clue. Choose one small balancing behavior, turn it into one visible rule for the next month, and keep it practical enough that you can actually follow it. After a month, review whether it helped. Behavioral diversification starts with one rule, not a complete personality overhaul. There are a few common mistakes to avoid here. One is assuming that a good asset mix solves everything by itself. Another is ignoring emotional patterns because they feel less technical than portfolio allocation. Some people make rules so extreme that they become useless, while others expect instant change from habits that took years to build. And copying someone else's system rarely works well if it does not match your own tendencies. Behavioral diversification only helps when the rules fit you and are practiced consistently over time. Balanced diversification sits between 2 extremes. On one side is owning too little, where risk is concentrated in just a few positions. On the other side is owning so much that the portfolio becomes cluttered, repetitive, and difficult to manage. The goal is not maximum variety. The goal is enough variety to spread risk, while keeping the portfolio simple enough to understand and maintain. In practice, that usually means focusing on balance rather than quantity. A good portfolio should feel intentional, not crowded. One reason balance matters is that diversification has diminishing returns. The first few meaningful additions usually reduce risk the most because they move you away from concentration. After that, each extra holding tends to add less. What matters is not just the count, but how different the new holding really is. For individual stock investors, much of the diversification benefit is often captured by around 10 to 15 stocks, while 20 to 30 may add only modest extra protection. Beyond that point, complexity can keep rising, even as the real benefit barely changes. True diversification comes from difference. A portfolio can look impressive on paper with many funds or many securities. But if they all respond to the same economic forces, the diversification is shallow. Several tech-heavy funds, for example, may all be expressions of the same risk. By contrast, a mix of stocks, bonds, cash, real estate, and international exposure brings together assets that may behave differently under growth, recession, inflation, or market stress. That difference in behavior is what matters. Fewer shared risks usually means stronger diversification. Different asset types can play different roles in a portfolio. Stocks may drive growth during strong economic periods. Government bonds often hold up better when markets become nervous, though not always in every environment. Cash adds stability and flexibility, especially when you need optionality. Real estate funds can provide another source of return, even if they still share some connection with equities. Adding one truly different asset class often does more for risk reduction than adding more of the same type of investment. This leads to a useful rule of thumb about scale. Investors who choose individual stocks often need only about 10 to 20 carefully selected names to achieve reasonable diversification. Investors who use broad funds may need only 3 to 5 index funds to cover major exposures. A simple lineup can provide stocks, international exposure, and bonds without much complexity. These are practical ranges, not rigid laws, but they remind us that broad exposure does not require endless moving parts. In investing, simplicity is often a strength rather than a limitation. A small fund lineup can be extremely well diversified if the funds are broad enough. A total US stock market fund can give exposure to thousands of companies across sectors. An international stock fund can widen that exposure across countries and regions. A bond fund can add a different kind of return pattern and often a stabilizing role. Together, those three funds already reach far beyond what most people could build stock by stock. An extra fund only makes sense if it truly adds something different instead of repeating what is already there. Before adding any new fund or stock, it helps to look past the label. Different names can create the illusion of new exposure when the underlying holdings are mostly the same. A large cap growth fund and a technology fund, for instance, may overlap heavily in the same major companies. So ask a direct question before buying. What new exposure am I actually getting? Check the underlying sectors, companies, or economic drivers. If the answer is not much, then you may be adding more of the same risk rather than improving diversification. Sometimes the most effective addition is not another stock at all. If a portfolio already holds only stocks, adding an 18th stock may barely change how the portfolio behaves. Adding bonds or cash, however, may change that behavior much more meaningfully. Bonds can reduce overall volatility, and cash can soften swings while giving you flexibility. In other words, changing asset class can matter more than increasing stock count. That is a useful reminder that portfolio construction is about different functions, not just more pieces. Even a well-designed portfolio will drift over time. When one area performs strongly, it can grow larger than you intended and quietly increase concentration risk. Rebalancing helps restore the original mix so your diversification stays intact. For many investors, a simple once-a-year review is enough. That rule forces you to trim winners, add to lagging areas, and avoid letting recent performance become your strategy. It may feel emotionally difficult, but that is exactly why a clear schedule helps. There is also value in knowing when to stop. Once your plan already provides adequate diversification, extra holdings often create noise more than protection. They can add clutter, hide overlap, and force more decisions than the portfolio really needs. More decisions create more chances for emotional mistakes. At that stage, discipline becomes more valuable than variety. A useful stopping point is when each holding already has a clear role, and new additions no longer improve the portfolio in a meaningful way. Maya's portfolio shows that fewer holdings can sometimes create better diversification. She started with 4 technology stocks, which reduced some company-specific risk because she was not dependent on just one firm. But all 4 still shared the same sector risk, so a tech decline could hurt them together. She later shifted to 3 broad holdings: a total US market fund, an international stock fund, and a bond fund. Even though the portfolio had fewer positions, it gained wider exposure across sectors, countries, and asset types. Broader and simpler turned out to be both safer and easier to manage. A final self-check can bring all of this together. Count your total holdings, but do not stop there. Identify whether they truly represent different sectors, countries, or asset classes, and look closely for overlap in companies or industries. Then choose one change that would add genuinely different exposure, rather than just another label. Balanced diversification means having enough variety to manage risk, enough simplicity to stay clear, and enough discipline to stick with the plan. That combination is what makes a portfolio not just diversified, but usable.